Hello and good day everyone. Welcome to the 2024 Solutions webinar series. Before we start, there are some housekeeping information that I would like to share with everyone. Kindly do refresh the page if you can't hear the audio or if the slides are not moving. Widgets such as the slide area can be maximized and minimized according to your preferences of the layout. You are encouraged to send in questions during the webinar through the Q&A box. If there's insufficient time, speaker will follow up on those unanswered questions via email right after the session. We would also appreciate if you could give this webinar a rating on a scale of 1 to 5, with 5 being the highest. Presentation slides can be downloaded from the resource list along with other relevant articles as well. There are also links to useful resources such as the Automotive Events Calendar site where we list out all the upcoming webinar sessions. On-demand videos can also be accessed via this site as well. And for updated information pertaining mobility, please do refer to the Mobility News and Assets community site where contents are constantly updated to provide you all with the latest information. Also, to join our Automotive Insights and Analysis LinkedIn group where we facilitate the
Hello, welcome to our May 2024 S&P Global Mobility Solutions webinar. We're very glad that you're joining us today. Today's session will be focused on the North American medium and heavy commercial vehicle sales and production outlook. We'll also touch on powertrain trends. My name is Andre Davis, Head of Medium and Heavy Commercial Vehicle Forecasting here at S&P Global Mobility. And I'll be joined today by my colleagues Greg Jeanette and Manny Katakis. Further by way of introduction, S&P Global Mobility is one of 5 divisions at S&P Global, combining all our strengths to serve our customers across many industries. And just a note about S&P Global Mobility, we serve all of the top light vehicle OEMs worldwide, all of the top medium and heavy commercial vehicle OEMs worldwide, many of the top suppliers, as well as representatives from many other industries adjacent to ours. And with that, get into the body of the presentation. As mentioned earlier, today we'll be covering demand trends, production trends, and powertrain trends. We're going to go ahead and start off with a look at demand to kind of set the stage and provide the context for the rest. And just very briefly, the key message here when looking across North America is really that the region has solid prospects in the medium term through 2026. And we're going to go ahead and break that down in a bit more detail. Looking across our 3 countries making up North America, Canada, Mexico, and the United States. Just as a reminder about the definitions that we're using, we'll be talking about vehicles in North American classifications Class 4 through Class 8, including trucks and buses. We'll try to be clear which charts may include trucks only or buses only, but it is covering Class 4 to 8. Just as a reminder, Class 1 to 3 are covered by our light vehicle service. And then let's just kind of take a look with that in mind where we are. Looking at those vehicles, Class 4 to 8 across those 3 North American countries, really, as I mentioned, the prospects are quite good. And in fact, the prospects are pointing up in the year-to-date 2024, as you can see on this chart. This chart shows the annualized monthly selling rate trend across the region. And again, what's very evident here is that there's been quite a lot of recovery since the supply chain challenges of 2021, 2022. And we actually started 2024 very much on an uptrend. And now we're going to take a look at the countries behind the details, starting with the U.S. The U.S. itself reflects very much the same trend, perhaps unsurprisingly, as the U.S. represents about 80% of the region's total demand. And in fact, the the U.S. economy, also being the largest in the region, really drives not just the U.S. market, but also much of the strength that we see across the truck markets also in Canada and in Mexico. Let's take a quick look at some of the economic indicators in the U.S., and then we'll come back to the truck market indicators. So, taking a look at the top-line economic indicators from our Market Intelligence Division, the picture that we have here is one of a country that has been exhibiting fairly strong economic growth and one that is expected to grow about as fast in the year 2024 as it did in the year 2023. When we look ahead to 2025, that's when we start to expect to see a little bit of a slowdown. What's going on beneath the surface is a couple different things, but a couple elements that are evident that I'd like to draw your attention to. First of all, in the middle of the chart, I'd like to point out that all of this good growth has come despite a rather weak period for residential investment and for housing starts, which you can see there. Housing starts are expected to be perhaps flat in 2024, but then to fall off in 2025, a reflection of the elevated interest rate levels here in the U.S. right now. Likewise, we've been enjoying a fairly strong period of personal consumption for a number of years. That, too, is expected to begin to slow into 2025 and will be a background factor for the truck forecast. Finally, also, investment spending by companies, it's the same kind of trend, pretty strong numbers in recent years, expected to slow. The next slide here just shows a little more detail on a couple other indicators. The main one that I would like to note, or actually there's really two. One of them at the bottom, in the middle of the chart, I can draw your attention to the federal funds interest rate. That is an average for the year. We do expect interest rates to begin to fall in the U.S. in the second half of 2024. And then you obviously see the decline in 2025. So even as some of those indicators on the earlier chart will be slowing, as those interest rates do come down, that will eventually create conditions for a rebound in some of those indicators. Also, very importantly for our market, I'd like to draw your attention to truck tonnage at the bottom of the chart. This indicator has been running somewhat contrary to many of the other indicators, with a relatively weak reading in 2023, which is actually expected to become more positive in 2024 and to accelerate further in 2025. Okay. So with those things in mind, let's go ahead and go now to the outlooks for the truck market themselves. We'll start first with medium duty demand. Medium duty in this case covers classes 4 to 7, and the shape here is very, very pronounced. There's a couple things to note. First of all, again here you can see the strong recovery out of the supply chain challenges of 2021 and 2022, building strongly in 2023, and we expect this part of the market in total to continue to grow further in 2024 and then to accelerate in 2025 and even further into 2026. And these are not massive year-over-year increases that we're expecting to see, that they're modest, but they are in the 5 to 10% per year range. So they're modest but solid. We expect this part of the market very much to be affected also by the emission changes that are planned for calendar year 2027, new standards for diesel trucks that are going to make vehicles significantly more expensive. And we see many fleets, many customers probably choosing to buy the last of the vehicles available with the earlier emission standard in calendar year 2026 for reliability reasons, cost reasons, and others, and that causing a bit of a weak spot in the market than in 2027. Those are the broad outlines for the medium-duty outlook as a whole. The next chart will provide a little bit of color on some of the details. This chart here shows exactly the same forecast, but broken down by individual weight classes. Really the main message here is that there are some contrasting trends within the medium-duty space. It's not all going in one direction. If you look at classes 4 and class 7 on the left and right, it really does kind of look like that main trend, sort of steady growth from 2024 through 2026 and then a drop in those segments. But if you look in the middle at class 5 and 6, where there's also a lot of volume, what you see is something a little bit different. Let's start with class 6. Class 6 had a very strong year in 2023, and we actually expect this part of the market to weaken in 2024 and to stay fairly modest in volume terms in 2025. This reflects the usage of these vehicles. They're very popular in the lease rental space. Much of that is used for delivery, and it's tied very much to housing and the housing market. As we saw earlier, the fundamentals in that part of the economy are rather weak right now. And we see that strong jump in 2023 as having been driven primarily by a delivery of previously ordered vehicles, which is now running its course. And when we look at the monthly sales trends, in fact, we do see a slowdown having taken place in the second half of 2023, which we believe will extend into 2024. Some questions about the timing. There could be some possible upside in 25, but nonetheless, that's the story for Class 6. Class 5 is a bit of a contrast. We see this segment as having a very healthy future within medium duty, tied to the demographics as well as some of the uses of these vehicles. These vehicles are very important for utilities with municipalities. Basically, some of these use cases will grow as the population grows and as the economy grows. That's one of the reasons why we see Class 5 rising steadily over time, a little bit in contrast to some of the others. Also, Class 5 has been very important in e-commerce, and in fact, it was a bit of a star during the pandemic, as you can see by that strong 2021 number there. That obviously suffered a bit in recent years, and we do see that finally coming back this year and then building as we get to that new emission standard in 2027. Let's take a look at Class 8. Class 8 on its own represents about half of the truck market, kind of balancing the medium-duty volume. When you look at this slide, there's definitely some similarities in the medium-duty trend. We expect to see a peak in 26 and a drop in 27 around the new emission standard, but there's also some contrasts. One of the contrasts is that we expect the drop to be much more dramatic in 2027. We also expect to see a relatively higher pre-buy effect in 2026. Some of that has to do with the fact that the cost of compliance is simply that much higher in this space. And it also has to do with the kinds of customers that are buying these vehicles and the behavior that we expect to see from those buyers. Another contrast has to do with 2024. Unlike medium duty, we are expecting 2024 to be slightly weaker compared to 2023. And there's a variety of reasons for that. These vehicles were given priority for delivery during the supply chain constraints, so the fleet renewal cycle is a little bit ahead of the curve, and that pressure is easing a little bit now. Also, as we saw on the first chart with economics, some of those conditions around long-distance trucking, which these vehicles are heavily used for, are rather challenging right now, and are causing weakness in orders as well as demand for new vehicles going forward. So we've seen a lot of weakness on the truck tractor side in particular. The part of the Class 8 that's used in other applications, such as construction, for example, the straight truck side, more broadly speaking, has been much stronger. In fact, it's growing, but it's not large enough relative to the truck tractor side, we don't think, to make 2024 an up year. Just a couple other comments. The buildup in Class 8 is really not entirely due just to the regulatory change coming around 2027. There's also some fundamental reasons to see this part of the market grow through the middle of the decade. Some of that has to do with the interest rate reductions that we're expecting to see and what's going to happen there across the economy and construction in particular. There's always been a very tight relationship between interest rate increases and decreases and then the market, the Class 8 market. Some of it also has to do with capacity, which is shown on this chart here. This chart actually shows the relationship among Class 8 fleet capacity represented by the truck tractor count and the amount of work that that trucking fleet is asked to do represented by ton miles. That's the blue line. And then intermediating that is really the cost of moving goods or freight rates and how they change year over year represented by the gray bars. And the message here is that whenever the amount of work that's being done by the trucking industry rises more quickly than the Class 8 trucking fleet, that's when it costs more to do that work, when the freight rates rise more dramatically. And recently, we've finally seen a normalization or a rebalancing, rather, between the size of the Class 8 fleet and the amount of work it's being asked to do, and it is resulting in a bit of a weaker period in the freight rates, again, as we've already mentioned. But as we look ahead a couple years, we do see the freight demand, the demand to ship goods coming back, as you can see on the right, and that is going to create better conditions for the industry and create more demand for these vehicles in parallel to that pre-buy ahead of EPA 27. So in summary, fairly strong outlook for classes 4 to 7. Despite some differential trends there, overall quite positive. Class 8, we think right now is pausing a little bit because of weakness in the truck tractor segment, but has pretty good prospects heading into 2025 and 2026 before that decline in 27. Of course, the U.S. is not the only market in North America, so let's take a quick look also at our other countries, starting first with Mexico. One note on the Mexican data: many in our audience are probably familiar with the official data sources in Mexico. Those official data sources, we modify that data slightly, so our market totals may be higher than what you're used to seeing. This is a comparison from the year 2020, but the real point is that we are supplementing the official sources, or adjusting them rather, to also include Ford and Ram volume in Class 4 and 5. And we're also supplementing the official sources with a little more information about imported vehicles from China. That makes our market totals a little larger than what you may see elsewhere. Having said what's going on in Mexico, here again you see the annualized rate trend chart. Similar to what you saw for the region as a whole and for the U.S. alone, there's also a very strong start to the year here in Mexico. It's all the more remarkable in Mexico because the level of the market is already so high. If you look at where it's running, more than a 60,000 unit annualized rate, and then look across to the left, you don't see that very often, and it's been doing that now for many, many months consecutive. So we see a lot of strength entering 2024. We think the market is on track probably to be flat in 2024 and can still carry forward with considerable strength into 2025 and even 2026. And in some ways that's a little bit surprising, because when we look at Mexican fundamentals, we see economic growth over on the left is expected to slow. We see Mexico also has high interest rates on the right, just like the U.S. So it's a little bit surprising that the market is growing. But in fact, there are some good reasons for the growth. One of the reasons is the strength of the U.S. As prospects for the U.S. have become better, those have lifted the prospects for the neighboring countries because the economies are so intertwined. And it's also lifted trucking specifically. As the U.S. economy grows, that causes more cross-border trade, most of which is carried by truck. So that's part of what's been going on. The other thing that we've seen is that there's quite a lot of replacement demand in Mexico that needs to be satisfied. The age of the Class 8 truck fleet has increased about a year compared to pre-pandemic, and fleet owners are looking to try to restore their fleets to the structure that they had before. So there's quite a lot of pent-up demand driving the market, and a few other dynamics as well. People are taking advantage of the strong local currency right now, and there's been also a move on margin by some manufacturers from outside the region to increase exports, specifically exports from China to Mexico, which is increasing availability of some trucks at a somewhat lower price point compared to some of the North American competitors, and creating positive conditions for fleets looking to acquire vehicles. One other factor has been the looming emission standard change in Mexico, which we think may create potential for a little bit of a pre-buy similar to the U.S. Right now, that fuel standard, we think, is on track to be implemented in 2027, as this chart shows. So when we look at all these factors, we see a pretty strong period for the next 2 or 3 years, especially for Class 8. One other note, buses, in the case of Mexico, last year finally recovered close to their pre-pandemic level as transportation for tourist purposes as well as urban in urban context have finally begun to normalize. Finally, looking at Canada, our last North American market, again, much like in the other cases, there's an uptrend in Canada. And when we look across at the economic indicators for Canada, there are some similarities with the U.S., but also some differences shaping the outlook. One difference when you sort of scan across the indicators shown is that, somewhat in contrast to the U.S., Canada is expected to see an acceleration now in economic growth, led by an acceleration in private consumption as well as investment. So all of those growth rates are expected to get better now and into 2025 and 2026, not slow down as was the case in the forecast that we showed for the U.S. So there's a little bit of a contrast there. And when it comes down to it, though, that gives good chances for growth for Class 8 in particular in Canada, which in this case dominates the market, as you can see from this chart, much more so than in the U.S. On the other hand, you don't quite have the same peaks and valleys around that pre-buy that we have assumed for the U.S. So that's a bit of a moderating factor when looking at Canada compared to the U.S. And with that, I'd just like to go to the summary for North America. So again, the shape of the forecast here, as we said, strong prospects through 2026, a likely weak spot in 2027 and 2028 after that U.S. emission change, but by and large, good prospects, volumes at a high level. Various risks and opportunities certainly remain. Probably when we're looking at the risks and opportunities, the biggest ones have to do with economics, specifically what happens with inflation and interest rates. They have to do with supply chain. We continue to hear about some supply problems, which my colleague Manny will talk about. And of course, geopolitics also have to be considered when looking at prospects for the market in the next few years. With that, I'm going to go ahead and turn it over to my colleague Manny, who will touch on production prospects as well as supply chain issues.
Hello, I am Manny Katakis, Senior Research Analyst for North American Medium and Heavy Commercial Vehicle Production, and I'll give you a walkthrough on the latest outlook for Canada, Mexico, and the United States. Is the total America, and it's since been lifted for 2024 and 2025, and compared to the last forecast, and this creates less of a volatile line ahead of a major 2026, which is expected to have large pre-buy activity ahead of the EPA 27 emissions mandates coming that year. 2026 holds the expectation of around 734,000 medium and heavy trucks and buses produced in North America. And the upcoming EPA 27 emissions mandates coming in 2027 require new levels of compliance, while registering any new truck beforehand can give operators an extension on driving familiar equipment. 2026 may call into question production capacity limits for the industry, but we currently expect that it can meet this figure as we have that data, with the industry reserving the ability to add overtime or weekend shifts as needed. Order backlogs are receding from 2022 and 2023 levels, but this can be considered a sign of a bit of a market pullback, which we currently have in place for 2024 year over year. And then after the major, we can say the pre-buy bubble, demand bottoms out in 2027, and recovery is expected through the end of the decade. Now, as we look into this short-term outlook, there are some supply chain undercurrents. We have whether or not like engine suppliers can build all the engines that OEMs demand of them, frame rails, etc. But right now they seem to be sort of like isolated flashpoints. It's not we seem to be pretty much in the clear of the major production constraints, COVID-related headwinds that we've seen the past couple of years. The USA continues to be a dominant producer for medium and heavy trucks and buses, making up about 68% of total production volume this year for the entirety of the region, and nearly 63% in 2026. The OEMs continue to rely on Mexico for highly essential products, especially to produce Class 8 heavy trucks, which is far and away the biggest segment of this region. Mexico plants have also proven to be flexible, with OEMs adjusting their production mix between similarly tooled plants in the United States and their sister plants south of the border. OEMs such as Daimler Truck, which makes Freightliner and Western Star, PACCAR, which makes Kenworth and Peterbilt, Traton, which makes the International, and Toyota, which makes the Hino trucks. They all have a footprint in Mexico as well as the United States, and then recently Volvo Truck has announced that it intends to build a heavy truck plant in Mexico to support the North American market by 2026. And as you can see by the chart, Canada being the purple sliver at the top, the manufacturing footprint for medium and heavy commercial vehicles remains limited compared to the United States and Mexico. And as we divide the medium and heavy commercial vehicle market, we can see that Class 8 is far and away making up the majority of production and volume in the region. And I kind of want to take the time to focus on this a bit more, and because this is not only expected for years to come, but also it seems to kind of take on the responsibility of where this whole market goes year after year. And even as we see the discrepancy between the heavy truck market, which is Class 8, and the medium duty market, which is Classes 4 through 7, we do see growth in Class 5. It has been steadily growing. And of this entire mix, the top truck in North America by production volume is currently the Freightliner Cascadia. And why is that important? Well, because the Freightliner Cascadia is currently the North America heavyweight champion and is primarily built out of one USA plant, Cleveland, North Carolina, and out of one plant in Mexico, which is Saltillo. However, starting this year, Daimler Truck has signaled that it will move production volume of the Cascadia to Mexico, as Cleveland will utilize the open capacity to build more vocational Western Star trucks. And we see on the donut chart on the right, originally about 10% or so of the mix of the Cascadia comes out of the United States and the rest Mexico. Now we see it's going to be pretty much Mexico entirely. And we also see on the left Class 8 on-highway volume and just how much of a proportion the Cascadia makes up of this entire segment. As the highest volume truck in North America, the Cascadia is expected to make up almost half of the Class 8 Mexican medium heavy production volume in 2024, and nearly half of the volume in North America's top 5 most produced heavy trucks. Generally, as the Cascadia goes in North America, so does the rest of the heavy truck market. This is why it's important to keep an eye on this vehicle. As we've lifted the North American production forecast for Q2 2024, it was most noticeable in Mexico, citing positive economic indicators for the country and pent-up demand for new trucks. 2024 production volume is expected to close slightly above 2023, trending steadily upwards towards a 2026 peak. Because Mexico exports heavily to the United States, the EPA 27 cycle will also be observed here. Keeping on Class 8, in late 2023, we saw a few major entries into the heavy truck market, such as the Freightliner M2 Plus vocational truck, as well as an engine update for Traton's International LT on-highway truck. And then earlier this year, PACCAR's Peterbilt followed up the beloved 389 with the new and equally retro-styled 589. Later this year, we'll see the new Volvo VNL launching at really between somewhere late Q4, and it's expected to offer several multi-fuel and electric propulsion systems through its life cycle. It's going to be the first volley of the truck maker's next generation of Class 8 trucks. And keeping on the Volvo for a moment, an immediate follow-up to Volvo's Mack Anthem and Mack Pinnacle on-highway trucks is not expected at this time, as Mack is expected to transition back to a vocational-only truck brand, leaving sister brand Volvo to handle all on-highway truck duties with the new VNL, as well as an expected new VHD and VNR coming in 2025. At the end of this timeline, the next generation Freightliner Cascadia is expected to emerge, launching just as the medium-heavy market hits its production apex. The legacy truck, the one on sale now, will likely remain for another year or two as the next generation Cascadia ramps up production. This capstones Daimler Truck's new heavy truck entries, which also include the aforementioned Freightliner M2 Plus, SD Plus, and Western Star 57X last year. This all signals that the Class 8 market is in the middle of a freshening for vocational trucks as well as on-highway trucks, leading to a pivotal 2027. So, in summary, from the production side, some key takeaways. There is momentum going towards 2027. We see the industry anticipating a strong 2026 after fluctuations in both 2024 and 2025, but again, less volatile than maybe we were expecting previously. This surge in production is expected to fall by 2027 as new EPA 27 emission regulations begin, dropping demand of new medium-heavy trucks and buses before recovering, at the end of the decade. Mexican production growth is also a major factor for the North American market, as its stronger than expected economic data has production outlook skewing positive for the country. Mexico is vital to several major truck and bus makers, including Daimler Truck, PACCAR, Traton, and can work as a flex valve for sister plants in the United States. And finally, there are several new heavy truck entries ahead of EPA 27, and they range from new engines to entirely refreshed cabs to new nameplates. But the most notable will be the Freightliner Cascadia. And with that, I'll hand it over to Greg to shine light on the region's powertrain outlook. Greg, the mic is all yours.
Thanks, Manny. So we're going to round out this presentation talking about the powertrain outlook for the North America market. I want to start talking about the regulations, and I think this is a good way to sort of set the stage because the regulatory roadmaps for each of the main countries are not only important for our forecast, but they're also critical for our methodology in determining the fuel type forecast for each of the main countries. Starting with Canada, we anticipate that they will, in fact, follow the United States and release new GHG regulations or greenhouse gas regulations in the upcoming months and years. This is something they've done in the past, and we don't expect them to change direction at this point. Another thing worth mentioning about Canada is they do have, at the moment, a robust incentive and subsidy programs going on within the country that will likely drive a significant amount of the zero-emission vehicle demand in the midterm. For the United States, there's no shortage of news in terms of the regulatory roadmap. Just recently, we've received the final greenhouse gas phase 3 regulation for the medium and heavy commercial vehicle market. Two things to note here is this does go from model year 2027 to model year 2030, and it's actually important to also say, which I'll talk about in the upcoming slides, the regulations were actually less stringent than the proposed regulations were about 12 months ago. As we know, the United States is going through an upcoming presidential election here in November, and the headline here, and as we go into the summer months and fall months, we're really going to be looking at, is this going to be business as usual, or is there going to be a change in administration that could have a big impact on the regulatory roadmap? And then finally, it's very important to note that California remains pivotal in determining the ZEV adoption rate with their own regulations and with regulations that other states are adopting from their market. And then in Mexico, as Andre also mentioned, we're looking at a delay in the transition to Euro 6 or EPA 10 standards until 2027, which will have some impact on market dynamics. Moving on, I quickly, we don't always look at the past, but I wanted to show this. This is North America production by powertrain, going back from 2010 all the way to the first quarter of this year. And I think it can tell us a few things, right? So for the North America, obviously what we're showing here is diesel and gasoline are truly dominant. And gasoline is a maybe more unique fuel type for the North America or U.S. market. So that's something to keep an eye on. And we do expect that zero-emission vehicles and other alternatives will eat into both of the share of gasoline and diesel engines. But one thing that's lacking from this graph is all of the lines at the bottom, right? So we have all the lower emission alternative fuels such as zero emission vehicles, natural gas. And that is why I put it on this slide. So what we show here is just the lower emission alternatives. And I wanted to show this because I think it can have some impact on what we're showing in the future as well. So I want to give an example. You see the hybrid line and the natural gas line in the 2013-2014 time range. Product availability in OEMs launching new products is really important, but it must follow other market dynamics to determine success, right? So hybrids came in, we had a little momentum, but then without stringent regulations and without better battery technology and lack of demand, OEMs started to take away this option. And same with natural gas. We saw a really strong peak with new products, and then it sort of faded away. And if we fast forward and look at the red line, which is battery electric, and you see it's starting to come up, creep around that 1% share, and you could be asking yourself, well, what makes it different from the hybrid line or other things? Well, I think a few things. So one is we have stringent regulations that are coming that will need zero-emission vehicles to comply, and then the other couple things are that all of the OEMs are really on board here. We see a lot of product coming to market. As I said, product availability is important for these types of graphs, and then we'll start to see some of the other market dynamics drive demand in the midterm forecast horizon as well. So this is something to sort of set the stage. And then moving on, I wanted to show this is the North America production forecast through 2031, and you can see the black bars here with some words, signals some critical signposts worth noting in the forecast. So I kind of want to take us through these. As Andre and Manny talked about, the 2020 low was because of COVID, but also the Biden administration took office in 2020, which could signal some changes upcoming. Really in 2021 and 2022, we saw a lot of OEMs start to launch zero-emission products. Ultimately, the volumes obviously didn't follow right away, but like I said in the previous slides, the product availability has to be there for us to get started on changing fuel types or different adoptions. As we head to 2024 through 2026, the overall market is, as again, Andre and Manny talked about, will be strong, but another thing worth mentioning is California's Advanced Clean Truck Rule begins in 2024, which requires OEMs to sell an increasing amount of zero-emission trucks. So you can see that red bar, which is battery electric trucks, starts to grow significantly. And then in the time frame EPA 2027, we know that there's going to be a market decline, but what does that mean for the powertrain forecast? It means a couple things. So we do see a lift in natural gas demand for compliance reasons. Natural gas engines would be good for NOx and other pollution compliance for the OEMs. And second, because of the high cost of complying with EPA 27 with a diesel engine, we do see some of the battery electric and other alternatives gaining share, as well as that total cost of ownership comes in view. And then the final, if you look at GHG Phase 3, as we start 2030, we do expect the zero-emission vehicle growth to be stimulated by OEMs complying with zero-emission vehicles, but with also diesel and gasoline technology. So that's there as well. And similar to the historical graphs, I now have just the alternatives in a graph, and I want to point out a few main things here. So one would be that we are looking at about 25% share of these, including natural gas. And then it's important to note that the battery electric growth is really going to be stronger and sooner than fuel cell, which I'll get into in a little bit. But it's important to note that we do see strong demand for zero-emission vehicles, but also natural gas as well. Hybrids, not so much, but it's something we're keeping a close eye on, especially if the regulatory roadmaps stays in view for the next 12 to 24 months. So moving on, I want to talk quickly about what the current environment is. And I think the best way to do that is to look what our current forecast is saying that was just published this month compared to our previous forecast. So I'll first start on the left-hand side here. So this is a battery electric truck production share. And as you can see, the red line is our current forecast, and the black line is what we published in February. And now we see a slight downward trend. That's coming from different product changes in terms of the product roadmap for particular OEMs. Like I said, the product has to be there if OEMs are in the market will adopt to these. The second is, like I said, the GHG Phase 3. We see a little bit less stringent regulations compared to what it was proposed in, so that is going to impact the forecast as well. Ultimately, the OEMs would have to sell less zero-emission vehicles to comply with regulations. Moving on to the middle, we see a bigger decrease in the hydrogen production share, whether that's fuel cell or H2 ICE. The wide variety of reasons for this is our expectation and our view of the hydrogen fuel prices are significantly higher than where they were, 6, 8, 12 months ago. So that is a adversely affecting our view on it, because we feel that the hydrogen costs are something that the industry is really going to have to figure out if we're going to see higher demand for these vehicles. We have a bit of product delay. Infrastructure is always an issue, and again, that GHG Phase 3. Moving over to natural gas, we're actually going in the other direction for this fuel type. So the reasons are twofold. One, obviously, like I said, we do see regulatory compliance is going to be good for EPA 2027 with a natural gas engine. And also, the new Cummins 15-liter engine that's supposed to be launched this year is also going to be introduced on several more trucks than we had it in the previous forecasts. And this really opens opportunity for the market to increase the natural gas share, as a new 15-liter engine can have fleets adopt natural gas in maybe vocations or segments that they didn't beforehand. So moving on, I want to talk quickly about some zero-emission costs, which is a huge prohibitor to higher adoption rates. And what you see on this slide is total cost of ownership. And that's, for us, that includes everything from owning, operating, and ultimately reselling, purchasing the truck. So what you can see here is the red bar and the blue bar are fuel cell and battery electric, and they're significantly higher than where the diesel is, even as we transition into the 2030s. The reasons for this include we see a significantly higher purchase cost, running costs for the hydrogen costs we talked about, a payload penalty for battery electric trucks because of the weight. Those things are not going to change. Those we see as the biggest prohibitor to the cost coming down closer to diesel. But the other point I want to make here is, as we look to update this model in this forecast in the coming months, it's almost looking like the costs may even rise or stay the same compared to where we were a year ago. And you can see some of the reasons for that listed here. So a lot of the companies in this market have had issues with their battery supplier, lack of economies of scale, inconsistent order forecasts for suppliers, and uneven BEV ramp up. So those are some of the things that can contribute to cost economics, and we're really not seeing a significant push to reduce costs, at least as we look today and maybe in the short to midterm. So those are some of the things we're going to look at cost. But again, the main point also is that we don't see a full TCO at diesel parity until here in the graph showing to the mid-30s. And something I said earlier, I talked about, uneven ramp up. So this graph represents United States and Canada BEV and fuel cell registrations. You can see there's, we started to uptake in start of 2020, as I said, product came online. But since the start of 2023, it's really been, I'm saying kind of uneven. So it's really been flat. And I've outlined some of the reasons here, such as infrastructure not available or taking longer to put online. The battery supply, especially in the trucking market, has been somewhat unpredictable with bankruptcies and other things. And then new product launches, especially from new OEMs or new entries, is prohibiting a higher uptake of electrification. So I've noted some of the examples here in the bullets, and these are actually from earnings calls of these main companies. So you can see that it's not just our information out there, but companies are really monitoring these situations. And if the infrastructure, battery supply chain, and then also new product launches improves, I think we'll see an improvement or acceleration in the adoption of electrification. So that's something important to note as well, and something that we're looking at. And I want to end the graph or this presentation talking about the internal combustion engine, the next two slides. So what you can see here is North America production for just an ICE, so diesel, gasoline, or natural gas. And we talked a lot about the electrification update, but for suppliers of ICEs or components of ICEs. This graph is particularly important. So we do see strong production and demand through 2026. We do see that market correction in 2027 because of the EPA emissions. And then the important point here is if we look at this graph, we never really reached that 2026 number again as it stands today. So ICE, or internal combustion engine production, is expected to peak in 2026. And then from there, from 2028 to 2031, we do see OEMs leveraging ZEVs or other things to comply with regulations. But really, that critical drop in 2027, we don't expect to get to that a level with sort of the forecast, the economic freight forecast we're working with today. But however, there are some things that could change this picture, such as a change in administration. Any big announcements from OEMs launching new engine programs could change this picture. And then also, obviously, any change in the underlying economics that our forecasts are tied to. So that's important. But the other main point is that, with this market kind of volatile and declining, there must be some winners and losers, right? So on the next slide, this graph represents engine production share gain or loss in percentage points, 2019 versus 2031. So what this means, if we look at Cummins on the left-hand side here, in our current forecast, we're showing Cummins having a 5.7 percentage point engine share increase compared to 2019, compared to the end of our forecast. So why? That means, we do see strong adoption for natural gas, as I said. They have a new 15-liter natural gas engine. We see that's going to gain a lot of share for them. Also, they've recently announced a diesel, EPA 2027 diesel compliant engine, which OEMs are going to certainly leverage as we get into the mid of our forecast. So really the point here is that new engine launches, diversification to other fuel types, like I said, will really aid production share for these engine OEMs. And then if we look at things like Traton and General Motors, they have new engines coming online recently and upcoming. And then on the other spectrum, Volvo and Daimler are very outspoken in electrification and things like that. So that's kind of how we see the ICE market at lower levels developing on an OEM basis. And finally, I just want to kind of summarize. I wrote here the North America powertrain production forecasting. Which way will the electrification pendulum swing? There's a lot of variables, especially as we get into the election, and we're taking those variables within our forecast and monitoring how the adoption is looking today. So some of the key takeaways for the powertrain forecast to keep in mind is definitely the regulations are going to shape the country's near and midterm forecast. By the end of this decade, production, natural gas, battery electric, hydrogen-powered trucks will for surely see the biggest increase, but it's important to note that ICs and diesel and natural gas will remain an important part of the playbook for OEMs and suppliers through the 2030s. So also I want to note OEMs definitely face a critical strategic decisions regarding the investment decisions, ICE for ZEV, and how that sort of shapes their compliance roadmaps upcoming. So a lot of good things to keep our eye on in the powertrain production forecast. With that, we will pause here and we will take any questions from the audience. But thank you for listening to the presentation, and we hope you enjoyed it.
All right, this is Andre again. Thank you again, everybody, for joining. I also want to encourage everybody to continue to look out for upcoming 2024 Solutions webinars. There'll be some coming here in early summer. Please look out for those. We now are in the live Q&A. Everybody in the audience, you should be able to submit questions in the webcast tool. Please feel free to do so. I guess one that I would like to ask, please take your time, is while while those are coming in, Greg, I think we didn't spend very much time on the distinction between hydrogen fuel cells and could you talk a little bit more about hydrogen fuel cells and hydrogen ICE and how those prospects might differ across regions?
Yeah. Hi. Thanks. Yeah, that's a great question. I think so. There's two main distinctions here. In our total cost of ownership modeling, which we saw, I think we draw on a lot to talk about the likelihood of adoption. H2 ICE actually had a significantly higher total cost of ownership, despite a lower purchase cost, which is unique, right? So the reasons for this are, the high hydrogen costs do affect both, but we see a significant hit in terms of efficiency when we're talking about an H2 ICE versus a fuel cell electric vehicle. So that's a main contributor, right? Because we all know that BEVs are highly efficient, fuel cells maybe a little less than that, and then H2 ICE is even more so. So that's going to be, let's say, cost is a big contributor, right? The second piece we're looking at is the regulatory environment, because as we know, in the U.S. here in California, they don't really include H2 ICE in the ACT and ACF rules. However, there's discussion currently on if they're going to include that. So from a regulatory standpoint, that could really have an impact as well. And I know in Europe, they can include it for some zero emissions as well. So that's, let's say, the TCO and the regulations are really the key parts there.
Okay. Thank you. There's another question that's related to powertrain that maybe we'll go to the vehicle side. The other question about powertrain, I'll just read it for the audience. There's a question about the captive ICE engines versus some of the independent manufacturers like Cummins. So I guess the question is, what's the outlook for the independents like Cummins? Can we say something about our outlook for those engine manufacturers?
Yeah, so I think to answer that question, yeah, it's interesting that Cummins has had such a strong increase. And I think, so two things. One, they're increasing, like I said, because of diversification. So obviously they're the only one with the natural gas engine, which we see, strong growth in, which is positive. And the other is that they're really, not to say this isn't going to happen, but publicly have stated that they're going to have an EPA 2027 diesel engine. So those two things are really fueling the growth. And then if we look at Cummins versus some other manufacturers on the medium duty side, they're obviously really strong with their 6.7 liter and then their 10-liter engine, which we've seen as well, is upcoming. It's going to be new. So I think to answer that directly, we see strong growth at Cummins because of those things, and then also we'll probably take some of the share from the the truck manufacturers in terms of the engine share. But one thing that could really change things is if we get some new announcements from these Daimler Packers of the world or Volvos of the world on launches of new engines in North America.
Okay, that works. And